Pick up on that with Stephen Nash from FIG Securities. So it sounds like everyone's on the same page. Stephen, anything particularly new or market moving from those events from where you're sitting?
Look, I think the speech by Obama is fairly important. However, a lot of this obviously will be outside his presidency, so he's really talking about something that he hasn't got much control on. However, I think it just emphasises the bipartisan support for a fiscal tightening in the US, which we're about to embark on. So I suppose that takes the pressure off monetary policy for the time being, in the sense that fiscal policy will be tightening and reducing the need for a tightening of monetary policy.
So you're speaking of the budget that Obama's put out overnight. Did you feel it was... I mean, IMF has raised questions about whether this is a credible budget, whether the US generally has a credible plan to tackle the deficit. Do you think that answered any of the questions today?
Well, I think I think it's a big positive for the US. I think the IMF was really just reflecting the existing criticism of the US, and I think market participants generally, that they had to do something about the budget. And it's good to see that there's been some moves to do that. I imagine the debate's going to focus now on how it's going to be tackled, with the Republicans opposed to any increase in taxation. So I think that's really going to be the negotiating point going forward.
What about, I mean, when we're looking at expansionary monetary policy as well, which we kind of started off by speaking about, you've got the US talking of it today, the ECB, we've got China with some numbers out tomorrow. The whole world then kind of starts to move in unison, but I guess there's still differences in the timing of all of this. How are markets going to deal with, I guess, this continued talk of monetary policy tightening? Well,
look, I think the thing to focus on as well is what's happening on the fiscal position. In Europe, Europe's probably ahead of the world in terms of austerity measures, and the effects of those austerity measures are going to come through this year. So I suppose that will take the pressure off in terms of what's happening in Europe. The US is starting to do it in terms of tightening fiscal policy. In Australia, we're looking at a tighter budget as well. So I think the emphasis should also be on fiscal policy, and that's really tightening globally at the moment.
The issue of the debt, though, it's not resolved now, is it? I mean, Obama's put out that plan for the next 12 years, but you've still got the argument over the debt ceiling. How long do you think that argument runs on for? And how much damage is done in the meantime?
Look, I think it's already done quite a bit of damage to the US bond market. US Treasuries have rallied a little bit on the speech last night, which is positive, but I think yields would be lower if they could resolve this budget problem as soon as possible. I mean, you've got a significant unemployment problem in the US, and you've got politicians trying to score points here. I think the bond market is really getting a bit fed up with this.
Stephen, can we ask you as well about the Glenn Stevens speech in New York overnight?
Yeah.
He was telling this American audience that basically the US isn't the centre of the universe anymore, which I guess, I mean, we talk about that all the time. How do you think that was received? What do you think was significant for us to take away from the speech?
Look, I think Stevens was trying to emphasise, you know, based on current growth projections, how important China will be in the future. Not now, but in the future. And I think there's got to be recognition of that in the US. The US are reluctant to admit that China could grow as quickly as forecast. There could be problems, obviously, with those forecasts, but the fact is, over the next 10 to 20 years, China will be much more important. So, given that, there's got to be some adjustment in terms of the way currencies are handled, and I think the message was that Australia and the US view currencies as a sort of a shock absorber, and China and the Asian countries view them as a possible disruptive mechanism. So I think over time, I think Stevens is trying to point towards that more free market or free floating exchange rate.
And so, should we be expecting that we will see appreciation in some of these Asian currencies? Are they receptive to that idea?
I think, look, if the currencies can appreciate gradually, I think that's the most likely course. I think it's good for China in the sense that it will help US growth, and if it helps US growth, it helps Chinese exports. So there's something in it for the Chinese. It also helps moderate their inflation situation. So there are positives out there. You know, it could be argued that it could be a really positive thing for the Chinese, but I don't expect the currency moves to be violent, and I don't expect large changes. Yeah.
Can we also ask about the Gillard speech, which also has happened overnight in Sydney? Again, we are going back to this idea of the budget, and not that they like to say anything before the budget, although they do. They try to get some messages out there, and there's certainly always leaks. What are you feeling the speech said on that line, on the budget, and what we should be expecting?
Well, I think broadly, we've heard it from a few officials now that the budget will be tough. There's also talk of changes to the welfare system, which is pretty unusual for a Labor Party, but I imagine that given the toughness of the budget, growth expectations will be reined in, and again, the pressure on monetary policy is reduced as this fiscal situation is reined in and spending is cut. So I think that's another important thing to focus on going forward.
What would be in the budget to suggest pressure had been taken off monetary policy specifically?
Well, as spending is cut, one would expect that growth expectations are moderated, and as those are cut, the need to tighten policy is reduced. It's not completely eliminated, and I imagine there's probably one more tightening still possible by the end of the year. But I think the general theme is that the budget will be tough. I think the politicians are softening us up for something which will be quite surprising.
Let me guess, tough but fair. I think we'll how did I know? Westpac's Consumer Sentiment Index yesterday, how does that play into this picture for the RBA? If we just bring it back to, I guess, monetary policy. Was it a positive for us yesterday?
Oh, look, I think broadly consumer sentiment has been quite low for the last year. It's been affected by natural disasters and a few other things. The fact is it is low. It could recover after the natural disaster effects pass. However, I think it also feeds into the idea of a cautious consumer who's unwilling to spend right now. Now, with a high Australian dollar, just to get people into shops, the pass-through of the high Aussie dollar from imported products is going to be accelerated, so we're going to get a reduced CPI as a result. So I think it's quite positive for the RBA in the sense that broadly the consumer's quite cautious and is staying that way. I can't see a radical change going forward.
Having said all of that, it seems like we're operating a little bit of an information vacuum at the moment with regard to our own economy. We've had a lot of statistics affected by the floods. What's the next very clear read we can get on the economy here?
Well, I think we just have to go with the partial indicators for the time being. It's going to be difficult for the next few months. The flood effects are going to be significant and very difficult to adjust properly for. I think we also need to look at the budget figures and the growth forecast out of that. I think that will probably be the time the RBA really starts revising things again.
Stephen Nash, thank you so much for joining us. Appreciate your time.
Thanks a lot.
Stephen Nash there from FIC Securities. Great to get his thoughts on all